Hello.
Hello.
Wow, already I see 7 people online. Good evening, guys. Welcome back. Another Thursday, and today's company it could be a company that you might or might not have come across on. Basically, it's a company listed in the US. Come 2021, we wanted to do a little bit extra for Not So Late Night Show. And as you guys know, inside our Malaysia Stock Exchange, you can only find as much companies to do, right? If I continue or we continue to feature Malaysia stocks, sooner or later we run out of stocks to talk about. And some companies, or there are quite a number of companies in Malaysia that that we wouldn't want to go touch or talk about lah. So the only rationale is to actually go out of Malaysia, and of course the default country that we always look at when you want to invest outside of Malaysia is US, the US market, right? And of course, in at the US market, you have a lot of companies. You have the famous FANG stocks. You also have companies like you might not have heard of, and Appian is one of them. So we will talk about what Appian is, and then for those you who know what Appian does, you can actually leave a comment. Maybe just give a teaser on what Appian actually does. So Appian is one of the companies that is having quite a big prospects because of the business that it's in. Basically, from the name, you might guess that it might have something to do with applications due to the APP letters that form the starting capital letters of its company name. So it's in the business where when it helps people to create apps. So as you guys know, apps are strongly becoming one of the default method or default channels for companies to actually react with their users. So take for example, even if you want to do e-banking on your mobile phone, you don't go to the website, you don't open your browser, Google Chrome, and then you type in Maybank to you. Straight away, you can download an app from the App Store. And launching the app, you'll go straight into the company's user interface, and then you can view stuff, you can do whatever transaction that you want. So apps is becoming more and more important in terms of business and also connection with our customers. So this is a company that will be changing the landscape of how app development and app deployment will be carried out. So I hope you guys enjoy this special company that we are featuring as today's Not So Late Night Show. But before that, maybe I would probably ask Chumbing, what are your thoughts on the app development and deployment landscape, and how does Appian or compete with the so-called competition out there, and what sorts of advantage that they have?
Yeah, I think the reason why we have chosen this not so famous company and not so famous industry in a way for most of the laymen like me and you, or anyone that's listening to this live. I think this is a very interesting company that you should know what they are trying to do. And also this is aligning with what me and Jupan trying to do. I mean, our original intention of doing Not So Late Night Show. I think we can be going all out to those stock that is popular, but then might not be having some sort of potential. But then we really wanted to introduce something that is interesting and something outside of Malaysia. So I think we can go straight away go into the topics, and then throughout the slide we'll be able to let you know more about this company.
Okay, cool. So before we proceed to the main topic of the night, so we will be rolling out our second program and this program will be called the Dividend Gems. So the first program we actually concluded last weekend. It was called Stock Plus 2021, and I hope that the so-called subscribers and participants have enjoyed their weekend, where KayaPlus actually pick up 10 stocks, 7 stocks in Malaysia, 3 stocks in US, and go through the PCs and also the risks of the companies. But coming up, if you missed it, never mind. Coming up next month, we have Dividend Gems. So it's open for registration, and the first batch that is going to sign up will be enjoying a special price of 388 per pax. So the subsequent so-called courses that will be coming in the second, third batch and foremost, it will go back to 488. So this is the so-called first introductory price that we want to offer to the early birds. And what does Dividend Gems teach, or what is it inside that? So it is a complete course where we offer you the steps and criteria to screen out good dividend companies. And dividend companies, on a very broad scale, you can divide it to normal companies, your banks and insurance companies, and your REITs. And all these requires different criteria to gauge because of the different nature of the companies, different ways the cash is actually being managed. So you actually need to monitor them separately with different kinds of criteria. And of course, since it's 3 companies, there are special metrics and KPIs to look out at and engage and test before you actually consider this as a good dividend company. And of course, by signing up a one-time fee of 388, you would enjoy a free for life course materials and related updates. Say, for example, coming 5 or 6 months time, or even 1 year times, there are additional steps that we think that you should actually take a look and also consider in the criteria segment. Yeah, it will get updated free of charge. There will be no need to resubscribe to Dividend Gems. And of course, whatever materials that we produce, we crafted, and the video replays will be accessible to subscribers, and you can do unlimited revision and playbacks as frequently as you want. So if you are interested, you can sign up at the link. We will be posting the link in the comment section. And here we go, Appian. So disclaimer as always, this is a company that we are bringing up to just share with you guys to just at least show that there are such companies out there. And if the business model is very interesting to you, you think the company is in the right nature of the business to continue to grow, by all means, do further due diligence, study further, and this does not constitute to a buy, sell, or hold decision from us. I will pass it to Chun Beng and tell us what Appian Corporation is all about.
Yep. So I think before we start about this company, I wanted to highlight this thing. So it's quite interesting because this company is actually founded by this guy called Matt Calkins back in 1999. And now he's still the CEO of the company. And he's the one that bring this company from nothing to get listed in NASDAQ, and then now is performing very, very well in the stock markets. So I would say this is very important because without the original vision from a guy, usually you cannot go that far. So it's the first thing I wanted to highlight about the company. But I think before we go into the next slide, I will play a very short video for you guys to know how Appian works, and then it will be easier for you to visualize what is the company that we try to share it with you today. Let's go for the video.
Appian combines the speed of industry-leading low-code app development with the power of top-rated intelligent process automation, all in one unified platform. That means you can build and deploy powerful new business applications fast, often 10 to 20 times faster than what you're used to. In Appian, you don't code apps, you configure them. Appian modernizes legacy apps and systems, consolidating their data and actions into easy-to-use applications, slashing time otherwise spent coding and testing. Every app built on Appian looks great, automatically, thanks to UX frameworks. Plus, with patented Sail technology, your apps are instantly mobile, available natively in iOS and Android devices, with no extra development time, resources, or money. Building apps in Appian is simple. First, take all of the data about an element in your business across all of your systems and bring it to one place. In Appian, this is called a record. Records can be anything: customers, contracts, products, vehicles, employees. Next, build the processes that interact with your records. Building new processes, no matter how complex, is easy with a drag-and-drop point-and-click process modeler designed for speed and power. Connect your process with your records. Now you're making informed decisions fast. Of course, it's easy to change, optimize, or extend your process to take advantage of new transformative technologies like robotic process automation or machine learning. And every application automatically uses Appian's native analytics, reporting, document management, and collaboration. Incorporating these features into your app design is as simple as drag and drop. Finally, for industry-leading security and mission-critical reliability, run on the enterprise-grade Appian Cloud. Of course, you can also run on-premises or on public cloud services like Amazon AWS or Microsoft Azure. With Appian, run anywhere, build powerful, unique apps, and do it fast. This is the digital transformation platform. This is Appian.
Okay, so hopefully this short video, posted by Appian themselves in YouTube, actually helps you guys to visualize what is the thing they're trying to do. If it's not, maybe we'll try to make it as layman as possible to tell you why we think this is something that is very, very interesting and can be very, very influential in the future development market, in terms of tech products. So, this few icon itself summarize what Appian can offer from a product perspective. I think we can go to the next slide. So, this is the three things that they are able to offer. Of course, from the origin of it is they are a company that provide a platform that is all about automation. Automate your business process, automate your development process, and so on. And then the second one is the concept they try to tell you is this is a platform that connect the dots. You no need to do unnecessary migration. Let's say if you have some tech products, usually you need to store all the records, and it can be into AWS and so on. Different provider can do it. So this is the platform that say you can store your data wherever you want, but I'm the platform that help you manage and automate the rest. Automate is the keyword that this company trying to sell their service. And then lastly is a term that maybe is not so familiar with most of you guys if you are not from the tech industry. It's a name called low code. Usually you heard of this thing. I have programmer doing the coding for me. But then what does low code means? Okay, go to the next slide. It's like what the video has explained to us. It's basically a process-driven kind of thing for you to define the processes and then make the application work as per whatever thing you have put in here. This is an example. Ultimately, every tech product or whatever business application is all about processes. You have a customer come in to visit your website, the first page, what you wanted to show. And then if they interact with your promotional banner, what you wanted to bring them next. If they go scroll halfway, 3 minutes, don't want to click on any product, is there something wrong? You need to give them a promo. All these things is actually a process behind the scenes. So this guy actually enable you to build or enable any enterprise to build the application without the need of very skilled person like all the programmer. As long as you're familiar with the process, you can build a very complex enterprise-grade kind of application. So this is the thing that they are trying to offer. You can go to the next one. Also, something that I've covered is not a place that they manage the database. You allow you to actually put your data anywhere. They are the platform that automate or connect the dots. Then you can go to the next one. So it's one platform, automate all your development work, and then instantly it will be mobile in everywhere. So meaning you put one effort defining the process, it can actually become the app you put into Play Store or App Store, or is inside the website. Everything is there. So this is how powerful they are. You just need one business analyst that don't have any tech background, but they can build end-to-end tech products for you easily through their services. Go to the next one. So some of the key stats that they are able to guarantee if you use their services to all the company that subscribe to their service, they are able to put this in their website telling you no matter what, you'll be able to develop your first app within 8 weeks. If not, then you can actually they pay you back the subscription fee that you have paid to them. And then if you have any person in your company that wanted to get trained, in 2 weeks, they make sure you are familiar with everything that you need to know, and then you can build whatever enterprise-grade product you want. Now, of course, because of all these things, you need to spend a lot of time dealing with so many layers. You have the business person dealing with the product person. Hey, I don't care how you do the products. I just want you to bring in more sales. And then the product is cracking the head. Try to gamify the entire site. Do some beautiful mock-up or wireframe to tell, when you click this to go there. Then when they pass to developer, because the nature, when you have communication, usually communication breakdown will tend to happen if there are more layers. So you have level 1, 2, 3, 4. At the end, then the product doesn't work well. Then you have a lot of 2 and 4. And then this causes a lot of development timeline. And it can be because of that, then a competitor launch the product or features faster than you. And then this is something that you don't want to see. And because of all this automation that Appian able to offer, then a lot of their customer actually able to see increase of revenue and then also faster development cycle. So this is the average statistic that come from all their clientele.
Interesting.
So probably I won't drill through this slide. A lot of people will have some simple interpretation is trying to say, usually when you talk about drag and drop, easily make kind of application, it cannot support complex logics. So if I'm a company like a bank, I wanted to build a bank app, probably I won't go for this. But what is actually telling you, I mean, from all these company, Appian is one of it, they're telling you it's actually possible because they got different tiers of coding practice, and then you can actually make it possible within their platform itself. So this actually make low code or all this automation getting more and more popular within the enterprise world, because now they no need to actually engage a very expensive or hire a lot of developer to maintain a system built by someone else, for example, or if they wanted to have a lot of new features being launched, and they wanted to test it out, all these things make it possible because they can keep on trying out new features. And then if they cannot, can just scrap it because everything is just processes. It's not a lot of effort they put inside doing the UI design, put the icon and all those stuff. So this is everything that is possible by Appian and some of the other low code company providers. Next one. So this is some of the recognition, which is, if you are from the tech industry, you will be seeing this quadrant quite frequently. Every year they will release magic quadrant for different industry. So for this case, the first one is actually low code, and then they break into X and Y axis. Top right corner is the one that having the highest score in both areas. So in this case, it's actually completeness of vision in terms of automating the application, and then also ability to execute. So Appian is definitely one of the top performer in this area. And then the right one is another reputable magazine or provider that tell you about how all these companies perform. This is something about business process automation. So they are also one of the company being recognized. Next. Okay, so you might be wondering, all this new company definitely won't have a lot of customer, or maybe they have one or two. Like, for example, now electric vehicles only having the volume of about 2 to 3% in the entire vehicles market share. But then you'll be surprised that actually a lot of they have a lot of customer, and then this is some of the customer that probably you will be seeing or heard of them before. So they are already into all these big boy. As collaborating with all these big boy to deliver the solution. Some of the name, like for example, Barclays, Deloitte, KPMG, Credit Suisse, and so on. So all this is a big name that already adopt some of their department using these low-code automations offered by Appian.
So quite interesting that how big companies are also slowly being more receptive on the introducing up and coming apps services to their business as well. So yeah, thanks for jumping to share out of the offerings, the business, and also the prospect of Appian when it comes to app development. As we talk about, app is always going to be a key metric or key channel that companies would want to interact and ensure that customers or even clients go through a seamless process, be it executing something or even buying something from their apps. So after going through the business, let's go to the numbers, which is one of the reasons or one of the factors that investors will actually want to look at before investing in a company. So you can see that income statement wise, this company, of course, is a growth company. You will see that the revenue is increasing year on year. So it has been on a steadily increasing trend. But one thing you might also notice that this is a company that is not profitable yet, right? So it has been reporting negative or losses, operating losses, and also net losses throughout the years from 2017 until trailing 12 months. So, but the good thing that you will want to take a deeper look is that, yeah, it's a growth company definitely, and in this competitive world, for a software company or even a platform as a service company, we call it PaaS. So you have to grow as fast as you can. You have to ensure that you hold or manage to hold significant market share, so that when the market eventually matures, then the road to profitability actually becomes easier. If you lose out on the sales straight upfront, then it will be more challenging to actually grab sales and revenue when your competitor is actually profitable and you are going head to head against it. So take it with a pinch of salt. A lot of software companies are usually loss-making when they started off their so-called growth journey. So one thing that you need to drill in deeper when you analyze high growth companies, and especially platform as a service company or software as a service company, is like the importance of going all out in grabbing sales and also investing a significant amount of their money that they have earned from their existing or ongoing sales to sales and marketing and also research and development. So it's straightforward. If your money is well spent on sales and marketing, definitely you would see higher growth in terms of the revenue. Subscription and also professional services are the two breakdown for Appian. So basically, if you want to use Appian, you don't just buy their license, you straight away subscribe for 1 year, 2 years, 3 years, etc. So it's an ongoing subscription model where once you are happy with Appian, you want to continue to use Appian, and once you finish a contract and then you sign a new contract, a new subscription with them. And along the so-called tenure or period where you encounter problems and you need someone to rectify it, be it bugs or be it support, then you can also communicate with the so-called professional services team at the Appian. They will be giving you the so-called solutions and also the help, but not free. So you still have to pay them some money, and that contributes to a portion of their professional service. But if you go down to what and how Appian is spending, you can see that over the past few years, since 2015 until 2009, have been spending increasing amount or percentage of their so-called generated revenue onto important aspects like sales and marketing and research and development. So it's a high growth, high intensity, and highly competitive landscape. These companies have to really be very aggressive when it comes to ensuring that revenue can grow. So they spend on sales and marketing, and also ensuring that their tech and their IPs are actually cutting edge, so that they can offer more and more competitive products and services to their customers. So that would actually come from the R&D segment. You have to put in money to do research and development. Only you can come up with more superior products to satisfy and to ensure your existing customers continue to subscribe from you. So what about the latest 3 quarters results? So from here, you would see all the numbers. But if I were to go to the percentage-wise, you would see that comparing the 3 months ended in September 30th. So you can see that it is still very much spending a lot of money, around 40+% of revenue in sales and marketing, and also a significant portion, which is around 23.5% in R&D. So added up, it's around 64%. So it's actually more than what they spent in 2019 total year. So you can see as positive way that this company is still very much willing to invest in terms of growing its upcoming prospects in terms of sales, and also the amount of R&D that they're putting in is to ensure that they stay relevant and competitive in this very competitive landscape.
But I think one thing to highlight also, what makes this thing very interesting is also, if you take the cost of subscription, go against the revenue of subscription, I think we should go to the previous slide that has a number.
Okay.
It's about 10% of it. So this kind of margin is not whatever top glove or whatever glove company that can achieve. I mean, maybe they can achieve during the very tough time of pandemic months. But then this is what Appian managed to get every single quarter or every single year. And the best part is subscription is an ongoing, is an growing kind of numbers from year to year perspective. So all is promising. So think of it, it's like you as a personal, you use a service from, let's say you subscribe to Spotify. Usually you won't let go already, because of you have put in the song that you like into some personalized playlist, and then it has your it knows what is the genre of the song that you like. All these things is already in. Then you rather continue to pay for it. Same goes to Appian. Once the enterprise is in, all their customers' information process is being constructed in their way. They won't actually leave. And with this subscription, we're just only going to climb higher and higher and higher. And then, of course, it's a very lucrative business that you can expect. But now they're just spending a lot of money to grab more market share, do more R&D.
Yep, which is very true. And I think you go back to the so-called percentage-wise, gross profit, 9 months as of 30th of September 2020, it's around 70%. So that means for every $100 that Appian earns, 30% goes to its so-called cost. Say, for example, servers, AWS, because they are launching or hosting on the AWS. After netting off all this, they still pocket $70. And out of these $70, they just overspend it maybe on sales and marketing, which is $42.6, and then $23 on the R&D. And then, of course, they also have to pay for the general and administrative kind of expenses as well. So so this is the type of gross profit that you would expect from software companies or even platform as a service companies, which is absolutely high. And because of the nature of the business it is in, is very competitive. They really have to overspend to ensure that they grow the fastest before the market becomes mature and saturated. And yeah, when we talk about business, we always want to see whether a company is earning its so-called revenue domestically, which is in the US, or it has a US outside of US kind of exposure. So you can see straightforward for the past 3 years, Appian has been also growing its international exposure. Back then, it was just 73% domestic, which is US, and 27% international. Fast forward to 2019, you can see that the contribution from the domestic part has dropped quite a bit, and also the international contribution has also kicked in. So this is a company that is growing globally, even though it is still unprofitable from its profit and loss, but definitely at a high growth pace, and that justifies the need not only to overspend in sales and marketing, but also grow outside of the US as well. So after going through and rationalize on the financial statements, next you go to the balance sheet, which is also a few key interesting points that we managed to capture and find. So you can see that for a growing company, they always need to invest in their so-called plant, their equipments, right? So that will actually contribute to the assets portion of a company. And if there is so-called any signs or proof that the company is growing, the assets will actually show some interesting growth also as well. So since 2017 and up to quarter 3 2020, you can see that the total assets have actually grown to from 161 million up to 492. So that's a very significant jump for total assets, right? Liabilities, I would say, relatively flat. At most, it's around 100 plus, less than 100% growth from 115 million to 194. And one interesting fact is that all these years, 2017, 2018, there was no debt. So 2019, some debt appeared, and also it got carried over and it increased to 61 million. And of course, equity portions also saw some interesting numbers. It was always 45 and 73 million, and then in 2019 it went up to 205 million, right? And last but not least, you can see that the cash portion also increased in tandem with the total equity. So what does that mean? So we've talked about how the company has been growing its asset because it's a high-growth company. They always have to invest in their new office, their new HQ, so that partially contributed to the increasing assets, and also they invested heavily in their so-called plant and equipment, and that actually parks and justifies the growth in total assets. Next, part of the rights of use assets are financed via the financial lease, and financial lease is categorized under debt. So you can see that because of that, actually reported a little bit of growth or presence of a debt portion in 2019 and 2020. And last but not least, you will see that why has the equity increased? Because they actually underwent extra and underwriting exercise. So in a way, what that means is that the company just sold more shares and raised more capital via the equity financing segment. So equity increased, and the cash generated also went into the cash and cash equivalents, which you see here. So company went for underwriting exercise, increased equity, and also increased the cash and cash equivalents on hand. So how does that translate when the company manages the cash that it actually raises from its future or subsequent underwriting exercises throughout the year? So this company, as you can see, the yellow bar, which is the financing cash flow, has been always on a very positive side. Means for every year, the company has been undergoing additional underwriting public offerings. So that increased or contributed to the ever-growing positive cash flow for the financing part. And operating, of course, the company's bread and butter operations are still in loss-making. So you can see that, yeah, it's always on the negative portion for the operating, but that doesn't mean you dismiss the company because it's a loss-making company currently. And last but not least, you can see that the investing bar also increased significantly in 2019. That was due to the investment portion that they pour in to make a new headquarters, and also the increase in the so-called investments in the plant and equipments that they actually registered just now also. So after going through and rationalizing on the performances and the figures of the companies, what would be the prospects of Appian, Junbing?
So I think now this is some of the things that usually we will check on for very new things or new technology or new solutions. I think a very good source is I think we make a mistake. It's actually Google Trend, not Google Finance in the source. Sorry for that. So if you go to Google Trend and you look for low-code development platform, you can see a interesting increasing interest that's started 2017 and then it showed up until now. I mean, this is the signal or the sign that this kind of platform is started to getting more and more matured and accepted by more and more big enterprise. So all this is the prospect that coming. This is just a starting. We can go to the next one, which is the prospect of the company. All in all, it's a very high margin kind of business model due to the fact that it's a subscription based. In here we put sticky PaaS, platform as a service. Technically, they are both PaaS and also SaaS player. If I were to share it to you guys, SaaS in the longer term is software as a service. So their low-code development platform is actually a kind of software that supported the user to do the development fast. But they also have something called the Appian Cloud that actually sell their platform out as a service to all the enterprise. So they are the combination of both, and they try to bring everything into one single platform and offer to the guy. Because you see, the three key offering is they are a low-code development platform provider, and also they come with some business process automation in it. Usually, this is the two separate things. If you talk about BPM, business process automation, or rapid RPA, rapid automation process, or whatever not, big name like Salesforce, all those people are in it. But if you talk about low code, then you have another bunch of people that are into it. But they are trying to be the one that bring in both and connect the dots. And then we can go to the next one. Yeah, I think this one is something that echo what we're trying to say. So you see about the retention rate. When you're in, you'll be in forever. I mean, not forever. Usually you won't leave them.
Yeah.
Because the fact that they control a lot of your business process, and most importantly, your data in some way.
And it'll be a whole hectic kind of activity and routine if you want to suddenly switch your current service provider or current software provider. So usually, due to the hectic migration or even upgrades previously, if you were to go through the so-called legacy licensing system, going through one patch from another was already headache enough. So that's why SaaS actually came up. SaaS means that you just subscribe with the way, and any updates will actually get reflected because everything is via cloud. And this is one of the so-called benefits or strengths of Appian, being a cloud subscription kind of software, where once people get into it, people wouldn't want to necessarily trigger any migration or any change of their vendor, because it's a kind of hectic schedule to actually go through every time if you want to change your software service provider. So we also talk about they are not alone in this space. So who are their competitors, Juming?
Yep. So in the eye of all this, that's why we purposely break into two major categories. One is low code, meaning by the definition of it, let me repeat, is very low in coding, process driven. So this is all the provider. I would say if you're familiar with it, our system is probably the one that is having maybe higher market share in terms of low code platform alone. But Of course, Salesforce is the one that coming in as well, ServiceNow and so on. On the other hand is all the business process automation. And then this one probably some big name that is already exists in the market for very long. Name like Oracle, Pega, SAP, or even Microsoft has their own BPM software to manage all the processes and automate all the thing for the business. So this is very competitive space, but they are sort of in a place that is leading in a way, recognized by Gartner and also some of the reputable in magazine or whatever platform that go through all this.
Yep. So after going through the business model, the value proposition, then the value that the company can offer to its clientele base, and also going through the numbers that it is currently rapidly growing, and it's incurring a lot of expenses in sales and marketing, and also our research and development. Before you buy a stock, you always ask yourself, what are you buying? And as of today, currently, what is the valuation of it? So straightforward, this company hasn't been reporting or recording any earnings. So straight away, PE ratio does not exist. So if you want to look at PE ratio, definitely that's not something that you cannot quantify and you cannot use it to value the company. But if you were to look at the current price to cash flow, so yeah, suddenly the company has been so slowly showing some signs that for that particular quarter, cumulative quarters, there's actually cash flow coming in. But you have to ask yourself again, where that cash flow is coming from. Since we already knew that the company actually recorded positive cash flow because of the financing cash flow coming from the underwriting exercises that he has been going. So don't let that trick you to believe that it's operating cash flow positive already. But if you were to measure against its price to book ratio, you will see that it has been hovering around 38 to even as of the highest currently, as it is at around 45 times. So straightforward, you are going to buy this company as of today with a price to book ratio of 45 times. So every asset the company owns, value at $1, you're going to pay 45 times to buy it currently when the market opens. So extremely expensive you just to look at the price to book ratio. But if you look at the value proposition, you look at the business that they're in, I would say that yes, there's a future for this company, but what kind of valuation would you be happy, or would you feel safe or more reassured when you invest it in? So that one is really up to each of us to interpret and also study further. And of course, enterprise value as of the current is around 13.34 billion USD. So share price, you would say that the company has always been loss making, but what actually triggered the company share price to go up from less than $50 a share just a few years back, right, 2017, up till 2021? It has went up from $40+ per share up to $200 per share. So these are the questions you need to ask yourself. Sometimes when you want to look into high growth companies, you want to look into very promising, exciting growth companies, particularly in the software and also the platform as a service kind of segment, you would really need to understand what the value proposition of the company is and what are the advantages they have versus their competitors, and then try to quantify what is the total addressable market. If Appian can sell software development apps, so how much are the so-called clients out there that actually need it? The forecast growth of this industry. So these are questions you really need to ask. And will the current price be acceptable if the total addressable market is huge and very prospective, right? That's why the share actually went up already from $40 up to $200+. But we are talking about future. What will the share price be 5 to 10 years down the road? And will this company continue to grow? So I think this is something that we really need to dig deeper. We already understand roughly how the company works but we still need to quantify the prospects of the companies in the coming years so that, if it fits your cup of tea, then this is definitely a company that you want to look deeper, and it could probably go higher given that the business and the requirements are quite relevant now and for the future. So there you have it. Appian, interesting company. Last but not least, of course, Stock Plus 2021 is closed already, but if you guys do want to get access to your replays and also our reports, you can still join. And if you have any questions, of course, we won't be doing the live anymore, but you can still leave us an email or get connected with us on our social media, Facebook, Instagram, and also YouTube, and also email as well. And last but not least, just another kind reminder, if you guys are interested into having a foolproof plan to finding growing dividends to actually fund your retirement journey, then by all means do consider checking out Dividend Gems. If you just want to break it down, 388 ringgit to master 3 kinds of strategies to look into dividend paying companies, bank and insurance companies, and also REITs. So yeah, by all means, I would say that it quite justifies the price and the so-called checklist that we are actually be sharing out in the beginning of March, 6 to 7, and the time would be 10 a.m. to 4 p.m. And that's it. I hope you really enjoy today's Not So Late Night show. And without further ado, let's go to the questions and comments to see what is awaiting.
Yeah, I think Joey put this name. You might not heard of them, but it's worth. I don't know. You should check this out. It's a company called Agora. Why they are so famous? There are a couple of stories because if you guys are following Elon Musk, you probably heard of this application called Clubhouse. It's a audio or voice-based kind of social media. And then what's so interesting about it, of course, is Elon Musk. He's making some announcement through the app itself. But then Clubhouse is not publicly traded. Then a lot of a lot of people try to speculate what is the thing they can write on. Because Elon Musk is, I think, if you talk about influencer, he should be one of the top influencer in the whole world. His one word can make the share now easily. So Agora is the software or platform or tech services provider that power the audio base within the Clubhouse. So what they did is basically it can be quite I would say complex. You can go through agora.io to check it out more. But basically what they do is they are able to allow you to build a product that is audio based. They can enable you to build an application that can do video call. You can do live interactive audio streaming, video streaming, and so on. It's mainly about audio and video based. So if you talk about risk factor of everything, I think Agora probably have higher risk because it's purely because of Clubhouse. It got shut up like crazy. So APPN probably more bulletproof in terms of their business model and also whatever thing they have been able to deliver. Interesting offer. Newly IPO or whatnot. The search behind it is because of Clubhouse and because of Elon Musk, of course. The second question, I think we sort of covered it. Basically, you can consider them as both PaaS or SaaS, PaaS or SaaS. So the low-code platform itself is technically a form of software they offer out as a service, but they also have APPN Cloud and all those things that they rent out their platform as a services to all these employees. I think this one, Jupan, you want to take this?
So what is the best broker for Malaysians to enter US market? Been looking at TradeStation Global. Is it okay? I think a lot of people would opt for TradeStation Global because it's Interactive Brokers are white label. So Interactive Brokers is actually one of the most prestigious and established brokers that a lot of people use to actually invest globally lah. So yeah, I think if you want to opt for TradeStation, then yes, I think it's a good choice. But don't quote me, because I personally am not using TradeStation. I'm just so-called giving you what I'm actually hearing from the people lah. I personally use interactive brokers. So, but yeah, I have not actually been hearing any negative or other comments for TradeStation. And from what I heard, it's quite equal in terms of the services and also the functions as well lah. So yeah, I think you can consider them, but yeah, but do dig deeper. I was always say that each brokerage have their own advantages and disadvantages. At the end of the day, you have to accept the disadvantages of the brokerage, and then if you accept that, then yeah, there wouldn't be any problem to actually continue using the brokerage that you choose lah.
I think I do
Yes.
agree lah, but there's a reason why we try to do all these things. I think Appian itself is worth sharing as a company alone. Maybe you might not be interested in them, but then low code definitely a big thing, in my opinion, in the next few years or next decade or whatnot, because the fact is automation is the key thing within the development of Industry 4.0 and so on.
Yep. I think at the end of the day, as I said, you only have that much US companies or that much Malaysia companies, sorry. So you wouldn't want to limit your so-called horizons just within Malaysia lah. So that's why we actually chose to step up of Malaysia, and then not just talk about the cliche US companies, but also go to what could actually be the upcoming prospects and exciting companies. And of course, Appian is one of them. But of course, hopefully more and more people catch the traction and also get more interested in SaaS companies and so PaaS companies as well. So yeah, but of course, those who actually tune in to listen and watch, I hope you actually learn and also broaden a bit of your horizons. And the SaaS world, PaaS world is really, really very huge. We are also still learning. Let me clarify. TradeStation Global.
No, I think it should be different. They are just using interactive broker as the base of it, and then they
okay.
So think of it.
Yeah, that should be more correct.
Yeah, think of it like this lah. If you white label is not a familiar term, they are like Maxis, white labeling TM, Unify or Backhaul, all these internet services, and offer as another service. So TSG is like Maxis, offering broadband, but then behind the scene is actually TM, and then IBKR, Internet Broker, is actually TM. Yep.
Appian has been operating for quite some time, but is still loss-making. How long did Tesla become profitable? Just for an idea. Good question.
Tesla is there since 2013, if I'm not mistaken, or 2014. It's about 6 years plus. Appian is about now, I think, 3 years plus. If I'm not mistaken.
Tesla just profitable just lately, right?
Yes.
So 2003 Tesla Motors got founded, right? Founding, yeah, 2003, and 2020. Let's assume 2020. So it took Tesla 17 years to actually break into a profit. And if you guys were to go and dig deeper on how Tesla managed to achieve that, they actually achieve it by selling carbon credits, right? So because they produce zero emission vehicles, they have that quota, and they are selling off that quota to your Chevrolet, all this kind of other Ford Motors. So that actually contributes to some earnings to Tesla. But for Appian, they are not enjoying any so-called tax credits or carbon credits that the government is actually sharing or actually rolling out to the so-called zero emission vehicle producing companies. So yes, you can argue that Appian is still loss making, but trust me, when you look at the so-called breakdown of the expenses, right, you see that just now we already showed you that out of $100 that Appian is earning, they actually need to expense out $30, and that is the so-called cost of expense that they need to pay, say to AWS and etc. The remaining $70, they can choose not to spend on sales and marketing. They can choose not to do R&D. They might need to pay out a fraction of them for the general admin kind of thing, and that would be the profit. But judging from the fact that they are operating in a very competitive business landscape, there is a need for them to actually spend money on sales and marketing to grab more market share and also to do R&D. Whereas for Tesla, it is in a heavy asset intensive kind of business. Net of all the metal, the so-called steel that they need to make the car, I think they are only left with $30 out of $100 of sales that they need. So the gross profit margin is around 30% only. And of the 30%, they need to still spend on R&D, they still need to spend on sales and marketing, they still need to spend on your general admin expenses. So the margin will be very, very, very thin for heavy intensive industries like a car manufacturer versus software or like intensive business like Appian. So you have to really weigh it out. I think it wouldn't take Appian 17 years to break into a profit. I would expect them to record a profit, say maybe 5-10 years. It really depends. It's quite dynamic, but it wouldn't be as difficult as Tesla into turning into a profitable company. Good.
You want to cover this?
Honestly, I haven't been looking at the pharmaceutical companies, but I think Pharma Niaga price, I guess, should be going up because of the positive news on the vaccine bottling news. But I think at the end of the day, I always like to ask the question, what next, right? So if Pharma Niaga eventually becomes a strong proxy or strong candidate to actually do the rebottling service of the bulk vaccine after pandemic 2020 or 2021, what is next for the company, right? You have to ask yourself that question now. So one-off catalyst, just like your gloves, I wouldn't want to like bet that oh yeah, maybe there's a pandemic 5 years down the road, 10 years down the road. That one is too ambiguous already, right? At least for Appian, we know that more and more people or more and more enterprises would be trying to launch their apps by themselves and without hiring and putting a lot of time and energy into developing an app using the traditional method. So that one actually easier for me to justify that sooner or later people will always want to spend money to expedite stuff, and app and software, this kind of interface would be one of the key components that Appian would be positive to grow in. Oh, this one is also a very interesting company. I won't doubt that Palantir have their so-called IP and technology into delivering their software. The one thing that maybe separates Palantir from the big tech is that if you look at the founders' biodata, Palantir is a company that is built to actually ensure that the Western world remains superior to the Eastern world, which is Asia. So there's always this kind of competition between China and also US. And then Palantir is a company that will be doing its very best, supplying its key technologies to help ensure that US remains the most powerful country in the world. They have stated in their IPO prospectus they will not be working with China or the CCP. So it's basically a tech company, but with very strong imperialism mentality. I wouldn't say that their technology is not good. It's very good, just that you always have to take note that this is a company that also has some other catalysts added to it. So they will always ensure that US government will work with them closely so that US government will not fall behind in terms of whatever aspects that will impact US position as world number one in terms of strongest company.
No, I want to add something. Ultimately, they are, in layman term, they help companies link all the data and then process them into some useful and actionable item. These come with some restriction that only company with a lot of data will need this service. In another word, maybe the margin is very high, but Appian margin also very high. And Appian is actually in a business that everyone need to build application, not mobile app or website, it's application. So it's more for the mass market. So the is much bigger compared to Paladin, which is very focused and very niche.
Because the very fact that Palantir is serving so-called trade secret, top secret kind of information, this kind of information will not be available or will not be stored in the cloud. So if Palantir wants to service, say, for example, a specific US government kind of a mission or kind of a task, they will have to actually dispatch one of their key lieutenants or key workforce to actually go to the so-called physically located server and help to pull the data from the server. So this server is private server. It would be stupid to actually put such sensitive information on the cloud and be susceptible to hacking from other countries. So very intensive kind of software or data analysis company, and not definitely going to attack or to serve the mass market lah. So you will be actually looking at it more from the US government catalyst point of view rather than the software edge that the company has lah. US market versus Malaysian market, which one is more volatile? I think if you want to look at it at a very broad term, maybe US, but I think if you zoom in into singular stock, I think doesn't really matter. Stocks are volatile in nature. Sometimes one news can make companies that are not volatile become volatile. And I think volatility is also an investor's friend. So if the share price is volatile and it goes down to a attractive price, then as an investor, you should be happy rather than be afraid of the volatility. Definitely will feature more exciting companies and broaden each of our horizons, not just you guys, but also ours as well.
So I think comment on this. I mean, the nature of the business is very, very different. Electric vehicle, if you talk about that, of course, you know, because it's consumer product. You will know Shopee, Lazada, because they sell things to you as a consumer. But there are some, you probably didn't heard of Supply Card. It's a wholesale provider in Malaysia. You might not heard of Store Hub because you're not an SME, people that need POS system. So they are famous at their segment. So this is something to bring out lah. So the nature of B2B business versus B2C is very different in terms of popularity.
Correct. Maybe I'll let you make answer.
I think that's why I wanted to highlight, if you wanted to check out Appian in more details, you need to recognize two different terms. One is low code. Another one is business process automation, BPA, or business process management, or I mean, some terms around it. It's very, very different. And of course, some of the company is, for example, our system, I would say is a leader in terms of low code development platform providers. But then the people that try to bring business process automation into low code itself and allow you to build complex enterprise grade kind of application easily. I think maybe this is the mode. But of course, another thing about it is they are the first one to get publicly listed lah. If you wanted to participate in this kind of business, probably they are the only one that you can proxy in.
Yep.
The rest maybe not yet, maybe still earning money, and this is all the other things. For the company that dare to go public listed means their account, everything is audited. So all the number is real. Startup, you say they raise fund, they tell you they're performing. I mean, it's not audited. They are not obligated to share all the details, but listed company is no. So this provides you some sort of transparency, in my opinion. But in terms of mode or competitive, I would say it's still very competitive. New player, a few guys that you should check out is Cloud System, Mendix, and also ServiceNow. But they are the one that combine both low code and business process automation.
Yep.
I think there's another question about what is their recent surge in price. I wouldn't comment much. Pretty much because of what is the performance they managed to do during Q3, which we have shared in the slide. But you will be argue with us saying the increase in terms of revenue or whatnot is not aligned with the jump of share price. I do agree, but I would say the biggest catalyst is because of that. I don't know whether Jupan have additional view or not.
No, I think if you look at so-called the news out there, they are just saying that from a numbers point of view, it doesn't make sense. But just from those insider or those that are very familiar with the so-called SaaS and also PaaS development scene, they are actually quite bullish. Even it links back to one of the analysts, Morgan Stanley analyst that's actually or one of the Wall Street analysts actually gave improved kind of target price to Appian after covering it. So because of that, I think short-term momentum, you can see that the share price actually went up quite a bit lah. But overall, I think this is a company that is riding on the right track, right business model and right scale to actually grow. Sometimes business analysts, or if one or two of them, or even a group of them actually improve their so-called ratings on them, then the short-term price movement also will see some drastic rise as well. But you shouldn't really gauge or judge the company based on their few weeks kind of movement, but rather, yes, it already jumped because of the short-term sentiment, but moving forward, can the company still continue to grow, and will the share price appreciate also along the way as well? So we have one question on valuation. So valuation is mind-boggling thing. Yes, I do agree with you. The high valuation is determined by the market. And is there a pure comparison to match with? I think you can broadly match the other SaaS or PaaS companies out there. Do take note that it's not an apple-to-apple comparison, but they are very much utilizing a subscription model, right? So all of them actually have quite prospective growth as well. I wouldn't say that Appian is the one and only SaaS or PaaS you should look at, but take this as an opportunity, as what we also are doing as well, to not just look at Appian, but also look at other software as a service company and try to come up with a fair valuation. Say, for example, now you cannot judge the valuation. You don't have a PE. So that actually limits off one aspect to value the company. But you also can actually gauge the company by the growth percentage year on year, right? So Appian is not the only company growing. There are also ServiceNow, There's also other SaaS and PaaS company, which is also growing. So try to actually match and compare the growth rates of all of these companies. Is one of them actually growing faster? And if yes, why? And is it because it's a niche company? And is it because the prospect that the service the company is offering is actually having a bigger total addressable market? So this kind of function actually has more prospective client compared to a more niche segment. Just now we talked about Palantir as well. So Palantir would only be more relevant to the government agencies and also certain corporate. 50% of it comes from government agencies and 50% come from the normal corporate companies. So from there, straight forward, I already know that for Palantir to grow at a faster rate, it has to pick up in terms of the corporate. So that one is the one that actually is free for all market. And using the same approach, I would also ask back the same question when it comes to valuing Appian versus the other software companies out there. Is Appian in a more niche segment, or is Appian actually serving the mass market kind of requirement? And if the growth rate justifies and the higher total addressable market also is available, then maybe the higher valuation might be justified. Is JPacket an interesting company or just pure growing stock? I think the company has been around in Malaysia for quite some time, right? And they also have been quite important, played some important role for the past. I think previously they did YMAX, right, JuJuR?
Yep.
Yeah. So I would say that the difference between Malaysia tech company versus and our international one is that Malaysia one is hard for them to not only grow within Malaysia, but also to grow outside of Malaysia. Whereas for the US tech companies or even the international one, they have this kind of startup culture, startup mentality where they come up with a brilliant idea, and then from that idea, they can even take that idea, that product and service, and sell it to the big corporations, and they actually capture the client base. So this is what I don't see for local software or local tech companies. Doesn't mean that it will forever stay this way, but as of now, if I'm based on this kind of observation, I would really look more for international software companies or platform as a service companies versus the local boys lah. So yeah, which maybe ties back to, since I cannot forecast the prospect or the so-called offerings of, say for example, JPacket, I would say that the price movement will seem more like a speculation rather than a fundamental move lah. Francis, crucial to know the big trends and ideas and how they adapt companies and people's behavior. Yes, this is very true. And of course, for me personally, I don't work at a tech field, but I know that tech will actually play a huge part in our lives in the coming years. And if you were to also try to draw some connection between how tech will actually play a more important role in our lives and how I want to take advantage or to also ride on the growth of technology stocks in my portfolio, then that also gives me the kind of enthusiasm to, go through companies that I don't really know at first, but after going through them, actually I appreciate their business and also understand that, okay, this company might have a chance, given that it is currently in this scenario where people are slowly migrating to accepting their products and services. What's your view on US ETF in general? ETF in general, if it's a good one, be it the index fund or a specific niche one, say for example, ARK ETF, which is managed well and is investing for the future, it will always go up. Of course, there are also not so good ETF that have traded sideways, but the most important thing is you should actually know a bit of what the ETF is investing for. Say, for example, if you are buying the S&P 500 index, it is actually a bucket of or basket of all the top US 500 companies on the S&P 500. So in the long run, US ETF or this S&P 500 will always climb higher. You will have the super overachievers pulling the normal companies and also the lousy companies up as well, and it gets revised. The not so performing companies will get replaced by the performing companies one. So if you're someone who don't like to analyze, dig deep into a certain company, then yeah, by all means you can consider US ETF. You won't get very exciting returns, but at least you are definitely going to beat the inflation rate. Okay, but it's not available to fund the account from Malaysia. Any advice? You might need to check with the customer service. I think you can go to their website, and I think they have set up an office in Singapore. You can call the Singapore office and try to clarify them. Of course, do note that you are actually calling international call, and international charges applies. But yeah, if it's a one-off call to solve your problem, by all means, just go ahead. Previously, I have also called Interactive Brokers when they have not opened their office in Singapore. Back then, I have to call to Japan, which is their Asian office. So yeah, that sorted my problem, and I'm happy that I made a call. And usually, quite fast service lah, quite instant. You will not be put on hold too long. And yeah, I just hope that a call, even though it's an international one, a short 5 to 10 minutes is actually able to solve your problem, and you can start your investing journey, investing outside Malaysia. So, wow, even though it's a new company, the crowd isn't as much as previously, but we still managed to answer and hold on until to 10:18 p.m. So, if there isn't any other questions, I will give you maybe just 20 seconds more if you have any. Of course, thank you for your time. It's always our pleasure to actually have all of you guys tune in on Thursday nights and listen to our sharing. And of course, next week would be the reunion dinner of the Chinese customs before the actual first day of Chinese New Year. So we would like to take this opportunity to wish everyone a happy Chinese New Year in advance. There'll be no late night show, so you can actually enjoy your reunion dinner without rushing to finish your dinner. And we'll see you guys probably 2 weeks time. So next week lah, after Chinese New Year, and everyone is back at their work. Even though the so-called Chinese New Year mood is still there, but we'll see you definitely on the 18th of February. And yeah, let us know which company you would like to be featured. And as always, stay safe. This would be a different kind of Chinese New Year that we will be experiencing. But let's hope that this will be the only Chinese New Year that is special for you and me. Next year's Chinese New Year will be back to normal. And that's all. We wish you all happy Chinese New Year and happy holidays in advance. Stay safe, and bye-bye.